What would actually happen if you stopped investing for 5 years? No contributions. No dollar cost averaging. No buying the dip. Nothing. Most people assume the damage wouldn't be that bad. It's only 5 years. I'll catch up later. I just need a break. But when you run the numbers, the results are shocking. Today, we're going to break down exactly what happens when you pause investing for 5 years and why the real cost is much bigger than you think. The scenario. Let's create a simple example. Imagine 2 investors. Investor A invests consistently for 30 years. Investor B invests for 10 years, stops for 5 years, then resumes for 15 more years. Both earn an average 8% annual return. Both plan to retire at the same time. Both invest the same monthly amount. The only difference? One takes a 5-year break. Seems small, right? Here's where things get interesting. The math behind the damage. Let's say both investors invest $1,000 per month. At an 8% average annual return over 30 years, consistent investing would grow to roughly $1.5 million. Now let's look at investor B. They invest the first 10 years, stop completely for 5 years, then resume for 15 more years. That 5-year pause doesn't just cost them the $60,000 they didn't invest. It costs them decades of compound growth on that $60,000. The final portfolio, roughly $1.2 million. That's a $300,000 difference from just 5 years. And that's assuming average returns, not missing a major bull market. The compounding effect most people underestimate. Here's what most people don't understand. Compounding isn't linear. It's exponential. The biggest gains happen in the later years. Year 1 to 10 feels slow. Year 20 to 30 is where portfolios explode. When you stop investing for 5 years, you're not just pausing contributions. You're interrupting the acceleration phase. It's like turning off a snowball halfway down the mountain. When you restart, it's smaller than it would have been. And smaller snowballs grow into smaller mountains. The real risk, missing the best market days. Now here's where it gets even more shocking. Markets don't grow steadily. A large portion of total returns often comes from a small number of powerful days. If your 5-year break overlaps with a strong recovery or bull market, you could miss a massive chunk of gains. Historically, missing just the 10 best days over decades can dramatically reduce total returns. And here's the problem. No one knows when those days will happen. They often come right after major crashes. The exact moments when people feel like stopping. What if the market goes down during those 5 years? Now you might be thinking, what if I stop investing and the market crashes? Wouldn't I avoid losses? Short term? Maybe. Long term? Probably not. When markets fall, that's when future returns improve. Lower prices mean higher expected returns. If you stop investing during downturns, you miss discounted opportunities. Consistent investors buy through fear. And historically, that discipline gets rewarded. The psychological cost. There's another cost people don't talk about. Momentum. When you stop investing, you break the habit. Restarting becomes psychologically harder. Lifestyle inflation creeps in. Excuses multiply. Fear builds. 5 years can easily turn into 10. Consistency builds identity. And identity drives results. Is it ever okay to pause? Let's be realistic. Sometimes life happens. Job loss. Medical emergencies. Starting a business. Major family responsibilities. In those cases, survival comes first. But here's the key difference. A forced pause is different from an emotional pause. Stopping because of fear. That's usually expensive. Stopping because of necessity. That's strategy. And if you must pause, at least keep your existing investments working. Don't liquidate out of panic. The alternative strategy. If investing $1,000 per month feels overwhelming, don't stop. Adjust. Lower it to $500. Lower it to $200. The habit matters more than the amount. Even small contributions keep the compounding engine running. Because the biggest mistake isn't investing less. It's stepping out of the game entirely. So what happens if you stop investing for 5 years? You don't just lose 5 years. You lose exponential growth. You risk missing critical market days. You shrink your future snowball. And you make restarting harder. Wealth isn't built in dramatic moves. It's built in consistent ones. If this helped you see compounding differently, subscribe for more long-term strategy insights. And remember, time in the market isn't just important. It's everything.